E ngā iwi, e ngā mana, e ngā hoa mahi. Tēnā koutou katoa. E mihi ana kia koutou, kua tae mai ki te tautoko tēnei kaupapa. Kei te mihi ahau ki Ayhan Kose, korua ko Franziska Ohnsorge, kōna kai kōrero o te rā. Tēnā kōrua. Ko Dominic Stevens tōku ingoa, nau mai haere mai ki te tai ohanga. Welcome everybody to this first installment of Treasury's new guest lecture series themed Productivity in a Changing World. I'm really looking forward to the discussion and things that we're going to learn over the coming year in this theme and at today's lecture. I'll just talk briefly about our new guest lecture series theme. We chose productivity as the first leg because productivity is such a key long-run driver of economic performance, wages, and well-being. New Zealand's productivity performance matters for our living standards. Higher productivity means higher incomes, cheaper and better quality goods and services. Real wages tend to grow more rapidly when labour productivity growth is strong, and we're more likely to increase in high productivity growth industries. But productivity doesn't only support well-being by increasing our incomes and consumption, it also gives us choices. Productivity might allow us to reduce our hours of work and enjoy more free time. And certainly higher incomes and consumption makes a difference to how satisfied people are with their lives. At a societal level, productivity expands choices across policies and opportunities for spending to support social and environmental goals. Higher incomes provide more opportunity to fund public goods and services that benefit us all, such as schools, hospitals, and infrastructure. Higher productivity can also protect future well-being by providing more income to invest in our national wealth and by enabling us to use existing wealth less intensively. In short, productivity is crucial for well-being. However, we must recognise that our efforts to lift productivity in New Zealand will occur in the context of a changing world. And that brings me to the second facet of our new theme, productivity in a changing world. Climate change means New Zealand economy is going to have to learn to operate in a warmer, wetter world at the same time as emitting less carbon. The global and New Zealand populations are aging, and that's going to change the way we do things. Technology is changing all the time with massive implications for how we work. The rise of artificial intelligence is the latest thing that could have implications for productivity growth, but might also require us to change the way we educate our young and train our workforce. The global geopolitical environment is changing. With hindsight, we perhaps now see that we've lived through roughly 30 years of a relatively peaceful global environment. Supply chains lengthened, new workers entered the global workforce, and the advent of truly global value chains drove prosperity and arguably productivity growth around the world. This helped keep inflation low and interest rates low and created excellent conditions for investment. We now find ourselves perhaps in a world that looks more like an era of deglobalization, or at least slowbalization. Countries appear to be turning inwards and the global order is becoming more fractured. Global supply chains and financial flows have been disrupted. Firms and countries are becoming more concerned with bolstering security as much as ensuring efficiency. Market access and competition are changing, requiring countries to navigate new alliances, new trade agreements, and geopolitical risks. A key driver of global economic growth may be slowing or coming to an end. Whether the changes are positive or negative, the fact that we're operating in a changing global environment and that will require significant changes in our economy if we're to sustain and improve our economic performance and productivity. So this new theme is going to feature a range of speakers who will explore the implications of these trends on New Zealand's economic and productivity performance and the sustainability and resilience of our economy. Now, I'll just talk a little bit about New Zealand's productivity performance. The economics community has been talking about this for many decades, and I wanted to highlight a couple of different perspectives on our recent history. So the dominant narrative has long been that New Zealand has a history of relatively poor productivity performance. New Zealand did experience a comparative decline in GDP per capita in the post-war years. From the late 1960s to the mid-1990s, real GDP per capita grew in New Zealand, but at a slower rate than in other high-income OECD countries. Since the early 1990s, New Zealand halted its relative GDP per capita decline, but has not succeeded in significantly catching up and lifting GDP per capita. While New Zealand significantly boosted its labour market participation and employment, we still had relatively low productivity growth. This appeared to be a bit of a paradox, actually, given our more stable macroeconomy, very flexible microeconomy, and the relatively strong wellbeing outcomes we observe that were highlighted in our recent wellbeing report, Te Tai Waiora. Explanations for this poor productivity performance have been covered in many publications, and they're very uncontested, but they include things like macroeconomic imbalances, capital shallowness, New Zealand's small market size and distance from other markets, low business R&D, the slow diffusion of productivity enhancing changes. Also relevant is the performance of the non-market sector and the role of our cities and the effectiveness of reforms to reducing barriers to productivity. More recently, an alternative narrative has started emerging, and it's something that work is progressing within the Treasury and elsewhere on this alternative narrative. This suggests that New Zealand's economic performance may not have been as bad as we thought. It points out that New Zealand's real income has grown faster than our real GDP, and since the 1990s has increased faster than in other advanced economies. The real income that we receive from our toil is what actually matters most for well-being, and the physical efficiency with which we produce goods and services is only one component of producing that real income. This alternative narrative points out that our incomes have also been boosted by a sustained rise in the terms of trade and to shifts in the structure of the economy towards sectors with higher export returns. Emerging work also suggests that New Zealand's measurement of average annual hours worked tends to produce systematically higher results than other OECD countries, meaning we may have underestimated labour productivity or the output per hour worked. These various factors suggest that we may well have a higher standard of living and well-being than our productivity performance alone might indicate. And we do see higher well-being in several measures, such as the OECD's Better Life Index and the UNDP's Human Development Index. Now, I'm going to be fascinated to see how this debate plays out on New Zealand's productivity history, hopefully through the course of the guest lecture series. Whichever narrative you end up ascribing to after hearing the lectures through the series, I think everybody does agree that one way or another we need to continue to seek opportunities to boost New Zealand's productivity in ways that will improve our well-being and the sustainability of our well-being over time. We have some excellent speakers lined up to delve into, discuss and debate a range of topics related to Ayhan Kose and Franziska Ohnsorge from the World Bank, who kick off the series today. Ayhan and Franziska have recently published a book called Falling Long-Term Growth Prospects, Trends, Expectation and Policies. The book highlights that productivity challenges are not unique to New Zealand. The authors note that the economic factors that have ensured progress and prosperity over the past 3 decades are losing strength, much as I was talking about earlier. So even prior to COVID-19, a global slowdown in productivity was already adding to concerns about economic growth and the impacts this will have on living standards. COVID-19 may well have added to these challenges. Ayhan and Franziska have identified an extensive menu of policies to boost growth and highlight 6 priority interventions in this changing global context. While the challenges and policy responses are likely to vary across countries, there is much for us to learn and consider for New Zealand in the policy menu that they will take us through today. So let me just briefly introduce our speakers, who are absolutely delighted to have us with today. Ayhan Kose is the World Bank Deputy Chief Economist and Director of the Prospects Group. He's a member of the Chief Economist leadership team, overseeing the bank's analytical products and policy advice. He also leads the bank's work on global macroeconomic outlook, financial flows, and commodity markets. Prior to joining the World Bank, he was assistant to the director of the research department and deputy chief of the Multilateral Surveillance Division in the IMF. Ayhan is a non-resident senior fellow at the Brookings Institution, a research fellow at the Centre for Economic Policy and Research, and a Dean's Fellow at the University of Virginia's Darden School of Business. He's taught at the University of Chicago's Booth School of Business, INSEAD, and the Brandeis International Business School. So welcome, Ayhan. Franziska Ohnsorge is manager of the Prospects Group in the Development Economics Department at the World Bank. Prior to joining the World Bank, Franziska worked in the Office of the Chief Economist of the European Bank for Reconstruction and Development on regional surveillance, forecasting, and financial sector policy issues. She was previously at the International Monetary Fund, covering a range of Asian, European, and Central Asian economies. Welcome, Franziska. So I'll hand over now to Ayhan and Franziska, who will present for around 45 minutes. Then we'll have about half an hour for questions and discussion. We're going to use the Q&A function in Teams for moderating our discussion. So post your questions in the Q&A section. We'll keep the chat just for technical type functions, and I will intermediate the questions at the end. So with that, over to you, Ayhan and Franziska, and once again, welcome.
Thank you, Dominic, and thank you for that wonderful introduction. It is a great privilege to be the first speakers of this series. So as I mentioned before the event started, big fans of New Zealand for a variety of reasons, but one reason I am a big fan because of the quality of living in New Zealand in many dimensions. So today we would like to have a brief conversation about our recent study, and we greatly appreciate the opportunity to present it. We have been presenting actually in a number of countries' events. We have a slide deck. We are going to go through that slide deck, and we will keep it as simple as possible. And we look forward to the the Q&A after the presentation. Let me share it as quick as I can here. Okay, here it is. So let me make sure I put this here. So everyone can see it?
Yes, but in a notes
mode. We can
mode.
see it.
There we go. This is good.
Now,
okay. So we can see it in the presentation mode. So Dominic already mentioned the book. The idea is quite simple here. There is a big debate about how much growth we would see in coming years. That debate has been around for a while. I think Dominic nicely covered the issues. We read, see, and live with how recent changes, technological innovations have implications, how we approach things, how we live, how we work. And there are excellent researchers. One of them is Erik Björfolson. He thinks that this machine learning systems become more sophisticated. We will ultimately have not only higher productivity growth, but also more widely shared prosperity. He talked about these issues, when you think about 5 years ago. Of course, there are all types of shocks hitting the global economy. We are yet to see the big benefits of these new technologies in terms of productivity growth and in terms of course, economic growth. And there are others talking about these issues. One of them is Robert Gordon, and I'm sure you are familiar with his work as well as Eric's work. His big idea is that, look, there are all these innovations, including machine learning, artificial intelligence. They make small inroads in fringe areas of the economy, but they are not making a huge change when we think about productivity growth in the aggregate. So maybe with the recent innovations we have seen, the ChatGPT, etc., we will end up using these technologies in a mass scale that really that they will have an impact. And there are significant questions to think about the consequences of these technologies, not just in the context of growth, but in the context of work environment and in many other areas of life. As economists, we have certain concepts when we think about economic growth, and those concepts guide our thinking. When Dominic was discussing the productivity experience in New Zealand, he talked about, the measurement issues, for example. The guiding principle most of the time is the concept of course, the potential growth. So in our new study, we are looking at the evolution of potential growth around the world, and provide we think that the first comprehensive database of potential growth. Looking at the kind of this evolution at the global level, at the level of country groups, at the level of regions and the countries, and then look at certain dimensions of potential growth when it comes to, for example, investment, and then look at potential growth prospects going forward. In a sense, try to estimate the potential growth under certain assumptions, and then end with these two well-known areas of research. International trade, it was seen as an engine of growth, but now most people look at international trade and claim that it lost its luster. It does not have the kind of the impact it used to have. For one reason or another, I think Stefan mentioned the issue of deglobalization, but that there is the other, in a sense, quote-to-quote engine of growth, the services sector, whether that could translate into, especially in some emerging market economies, the stronger growth and better prospects for the future. The book is available on the web. All the charts are available on the web, and the underlying data set available on the web. So we try to produce studies and make everything public so other researchers use the material and replicate what we have. So how should we think about potential growth? Let me briefly discuss this. So the definition of potential growth is, I think, well known. It is the maximum growth rate an economy can sustain in the long term if it utilizes all of its resources. It has full employment, it has full capacity in terms of its usage of its capital, and of course, without igniting inflation. So in practical terms, potential growth is an economy's speed limit. If you basically exceed that speed limit, you can easily end up with a problem of inflation. It is critical for policy formulation in different contexts. For central banks, it's very important to know where you are in the cycle relative to potential output, where you are in the cycle relative to potential growth. In the context of fiscal policy, in the context of the development plans, you would like to know how much the economy can produce, how much the speed limit translate into revenues, and how much you can make progress when it comes to certain aspects of development. So it is an integral part of policymaking, and institutions spend a huge amount of resources to get a good handle of potential growth. So the concept is very important, but it is an unobservable variable. It's a latent variable. It's possible to estimate it. And these estimations sometimes require, huge assumptions. So in the book, as I mentioned, we have these 9 most commonly used measures of potential growth for a very large sample of countries over a period of 1981 to 2021, and our the confidential database also includes forecast, which we work very closely with country teams when we make these country-specific estimates public. The good news about potential growth, it is possible to increase the rate of potential growth through policy interventions, that are going to translate into stronger productivity, stronger investment growth, and one way or another, better labor supply outcomes, not necessarily faster, population growth. So let me briefly talk about the measures of potential growth we are looking at. So our baseline measure relies on this well-defined idea of production function, which is, something you learn even in our principal classes. What are the big advantages? You basically link the estimates of potential growth to the inputs of potential growth in terms of productivity, in terms of capital stock, in terms of labor supply. But when you try to correlate the estimate of potential growth to actual potential growth, these correlations are low. Of course, over the long term, they tend to basically follow each other. You look at the long-term averages, decade averages of potential growth and actual growth. What is the big disadvantage? The production function approach, you need to come up with, the proxies for potential productivity, proxies for labor supply growth, capital accumulation, and there are significant measurement errors there. And Stefan already mentioned the case of New Zealand and the measurement of labor hours, for example. And then you need to specify a functional form, and that functional form could be, of course, different. The second approach, extensively used by central banks, relies on time series methods, and these are, filters. And there are a variety of ways of thinking about these filters. You can have a univariate filter. It's very simple to implement. Even if you don't have much data, you can implement. If you have the output data, you can get a potential growth estimate around the kind of the actual output. You can look at the trend, or you can use multivariate filters that are helpful when you think about the output gaps. And these output gaps, especially in the context of monetary policy, consistent with some indicators of demand pressures you see in the economy relating to inflation, unemployment, capacity utilization, you name it. And these filters, as I mentioned, extensively used, but there are significant caveats associated with them. We know these usual endpoint problems. It becomes very difficult to estimate potential growth with these types of time series methods when new data becomes available, because the estimation exercise gets difficult when you are at the end of the sample. They, for obvious reasons, correlate with actual output growth. So it's a good measure when it comes to reflecting short-term movements and thinking about, how potential growth changes. But at the same time, it's not necessarily very useful because the underlying potential of the economy, bearing you do not have, major shocks, shouldn't be changing significantly. Finally, we have long-term growth forecasts, and there we have professional forecasters. They forecast growth next quarter, next year, 2 years, 3 years, 4 years, 5 years, 10 years from now. And there are entities, they collect these types of long-term forecasts. The good news about these types of forecasts, of course, when they look at 5 years, 10 years ahead, they're ultimately about the potential growth of the economy. They incorporate judgment, and they are able to capture certain shocks that cannot be necessarily modeled during periods of high volatility, or you are not necessarily internalizing it. But hopefully forecasters look at the kind of the changes and they say, okay, when I look at 5 years ahead growth, I have an idea. I would like to incorporate the new innovations. I have an idea to incorporate the impact of a big shock like the global financial crisis or a big shock like the pandemic. These are also in terms of their disadvantages, quite persistent and sometimes difficult to interpret because there is judgment involved. So against this background, what we are going to do today, we are going to focus on 3 questions. The first one, how has potential growth evolved? And there, the message is rather straightforward. Potential growth declined between 2010 and 2011-21. And that's driven by synchronized, basically, decline in growth rates of drivers of growth. And of course, there are a number of shocks we need to take into account, adverse shocks. The second question, what are the prospects for potential growth for the remainder of this decade, which is important because, people refer to what happened after the kind of the episode we had in 1917-18 and how global economy flourished. There was the roaring 20s, the 1920s. And some argued that maybe after the pandemic in 2020, we will have another roaring 20s 100 years later. But our calculations suggest that potential growth will be weaker going forward, and there are significant downside risks. So this baseline we have, we might end up having even weaker potential growth. And finally, what types of policies can help lift long-term growth prospects? There are certain exercises we conducted there. One of the exercises involved what happens every country delivers policies that translate into reform efforts, their best 10-year reform efforts. And if that happens, it's possible to reverse the slowdown in potential growth. So a lot for policymakers to think about between this persistent slowdown in potential growth that ultimately affects, of course, the living standards and the need to be proactive when it comes to policy interventions. Proactive is a kind of an understated word here, being very, very ambitious. Throughout the presentation, we are going to use this acronym EMDEs, and that stands for Emerging Market and Developing Economies. What I am going to do, I'm going to talk about the first question, and then Franziska will answer the second and third questions. So the first question, how has potential growth evolved? Over the past 2 decades, there has been a broad-based slowdown in potential growth. And you see that in the aggregate data for the world economy as a whole, as well as advanced economies and emerging market developing economies. In the left chart, you see that global potential growth, we estimate as using the production function approach, decline from the first decade of this new millennium to the second decade. In the first decade, it averaged around 3.5%. In the second decade, it averaged around 2.6%. And then you look at advanced economies and emerging market developing economies, you also see that the decline was very clear in these sub-country groups. In the case of emerging market developing economies, the decline was around 1 percentage point. You also see the averages of actual growth during these 2 decades. You might ask one question: what happens if we change these periods rather than looking at 2000, 2010? What happens if we look at 2000, 2009, or 2011, 20, and then take out the pandemic? We have a number of these exercises in the book. Basically, you see the same trends. Now, we all know that there is this underlying population growth slowdown. Then the question is that, is it the case that we see this aggregate slowdown in potential growth driven by slowdown in population growth? So ultimately, we are interested in the living standards of a kind of an average person that should be manifested in per capita potential growth. And there as well, what you see is that per capita potential growth slowed sharply. It was 2% in the period 2011 to 21, and it was 2.7% in the previous decade. In the context of emerging developing economies, per capita potential growth declined from 5% to 4.2%. Now, like many things in economics, people have strong views about measurement of potential growth. When I talk to economists, especially in central banks, they have their favorite measures. So the next question to ask, what did we learn from these different measures of potential growth? So we can discuss the selection of sub-period. We can discuss the validity of production function approach. But on the right panel, what you see is that multiple measures of potential growth, and they all decline from the first decade to the second decade. So irrespective of the measure you used, this decline is evident, and it is evident in actual growth. So it's not like we estimated something that is declining, but in actual data that decline is not obvious. So the next question we need to think about: was the slowdown driven by a small number of countries, or was it broad-based? Here on the left panel, you see the share of countries experiencing potential growth slowdown and the share of GDP relative to, of course, the world GDP they have. And in the context of global economy, around 65% of countries experienced slowdown in potential growth, and that's close to 80% of global GDP, these 65%. In advanced economies, almost all of them. In emerging market developing economies, slightly above half of them, but the size of these emerging developing economies is larger than 80% of emerging developing economy GDP. Then we look at the regional dimensions. Here, in the context of regions, the World Bank has 6 regions operating 6 different regions. And the important point here, these are regions populated by emerging market developing economies, because those are in a sense, what we call credit the member countries. These are our clients. We are not focusing on advanced economies when we talk about regions. So there you have East Asia Pacific, EAP, Europe, Central Asia, ECA, Latin America and Caribbean, LAC, Middle East, North Africa, MNA, South Asia region, SAR, and Sub-Saharan Africa, SSA. And what you see here, other than South Asia and Sub-Saharan Africa, there is a noticeable slowdown in potential growth in every region. In the case of SAR, India has been a major player, keeping the potential growth rate high. And in the context of SSA, potential growth decline, but still comparable to the level we saw in the previous decade. So far, what we try to do, we try to establish a slowdown we see in advanced economies, in emerging developing economies, a slowdown we see in multiple measures of potential growth, and of course, a slowdown we see in multiple regions of the global economy. Now, the next observation, what were the kind of the drivers of the slowdown? If you look at the data carefully, and the drivers of the slowdown, don't forget we are using this production function approach, so we are able to look at the role of total factor productivity, the capital accumulation, and labor supply. So the slowdown also has been broad-based when you look at these fundamental sources of economic growth. On the left chart, you see the three drivers of potential growth: TFP, capital, and labor, and there they contributed almost equally to the slowdown in potential growth. Slowing TFP growth accounted for around 0.4 percentage point of this decline we saw. That decline was around 0.9 percentage point in global potential growth. Capital, 0.3 percentage point, and then the labor for another 0.3 percentage point. In emerging market developing economies, the slowdown was mostly driven by the slowdown in the TFP growth. The almost 0.6 percentage point of this 1 percentage point decline was driven by TFP growth, and the rest was roughly split between capital and labor growth. Now, one important observation is the decline in investment growth and how sharp was that decline when we look at, in the first decade of this millennium and in the second decade. And you see that in the right chart. So the investment growth sharply slowed, and that, of course, affected the accumulation of capital that translated into a weaker potential growth. Of course, capital has the embedded technology, and that affects the growth of TFP. Of course, during the pandemic, we saw a huge drop in investment growth, affecting a large chunk of emerging market developing economies. When you look at the center chart, you see the much of the decline in the context of emerging market developing economies. We see the potential growth over the past decade was driven by China. If you exclude China, the decline was smaller, but still driven by the TFP growth slowdown. So let me stop here and turn to Franziska. She's going to talk about what are our forecasts for potential growth. Franziska?
Thank you, Ayhan. So Ayhan showed you what happened over the past decade. And I think I'm showing you what's going to happen over the next decade, right? I hope you can see. So backward looking, it really doesn't matter which of our 9 measures of potential growth you take. because they're all down. Forward looking is a bit more difficult. We have only one measure of potential growth that we can use to project forward. And that is the potential, the production function approach. And just so you understand what we are doing, let me tell you a bit how we calculate it. So this is not a decomposition of actual growth. This is decomposition of potential growth, which means we have to strip out the business cycle out of all these components. So we do the usual Cobb-Douglas production function, but then we do it with this twist. Investment, we do like everyone else. We assume that the capital stock just grows with investment growth. TFP growth, total factor productivity growth, so the solo residual essentially, and labor force participation, the labor force growth. Those are the ones we estimate with panel regressions, as large a sample as we can find for as long a period of time as we can find. And the TFP growth, for example, we estimate that our potential TFP growth is the predicted value of that regression of actual TFP growth on things that drive productivity growth. They're known to drive productivity growth. So that includes investment growth, 5-year averages, that includes conversions to distance from advanced economy per capita GDP. So you get this catch-up convergence to growth. It includes working age population growth, and it includes education. So classic drivers of productivity, the basic drivers. And then we take the predicted value of that, and that is our potential TFP growth. That's what we call potential. And the same with labor productivity growth, with labor force growth, sorry. So we know from the UN how many people there are. Yeah, the UN population projections tell us how many people there are. What we don't know is how many of those are actually working in the labor force. So again, we run panel regressions by 5-year age groups separately for men and women of the labor force participation rate on, well, for younger people, fertility rates and schooling, for older people, life expectancy, and and then for everyone, various education variables. And again, the predicted labor force participation rate from these regressions, that's what we call our potential labor force participation rate, and we apply that to our UN population projections. So what I will show you now, the projections for global growth, for global potential growth, are built on these heroic assumptions. First, that investment growth continues at the pace that consensus currently expects it. Yeah, consensus might be wrong, but if consensus is right, you get the chart on the left. If the UN population projections are right, you get the chart on the left. If education and health improvements over the next decade, 2022 to 2030, are at the same pace as over the 2000s, as on average over the 2000s. So on those 3 heroic assumptions, you get that chart on the left. It shows you what will happen to potential growth, the blue bars in the baseline, between the last decade and the next decade, the remainder of the 2020s. So potential growth globally will fall by another 0.4 percentage point. And you can see in the yellow and the red bars, we split that into demographics and into other factors. And you can see globally, about half of that slowdown is demographics. So that's not just the fact that the potential working age population is growing more slowly. In fact, it's not growing anymore. In that sense, it's growing more slowly. But it's also the fact that older cohorts or older people older age groups, not cohorts, older age groups tend to work less. Their labor force participation tends to be lower, so they're less attached to the labor market. So both of these factors are in those red bars here. Yeah, and the orange bars are to a large extent the slowdown in investment growth that is currently expected in a consensus forecast. For emerging markets, developing economies, same assumptions. You can see that aging makes a much smaller contribution to the slowdown. It's really about investment weakness going forward. But you should bear in mind that the aging problem in emerging markets now is roughly the same one as in the late 80s in advanced economies. In the mid 80s, the working age population share stopped growing in advanced economies, and emerging markets were at that point in 2010, just after the global financial crisis. So this red bar is just going to grow over the next decade. So if we then, we get, the next question, the first question everyone asks when they see this chart on the left is yes, but in per capita terms. I mean, you get a sense of that already by removing the red bars. So even per capita terms, global potential growth is going to fall. It's going to slow from 2.7% in the 2000s to 2% last decade to 1.8% in the remainder of this decade. Yeah, and it's the same in emerging markets and developing economies. So the aggregate numbers, if you want to keep a rule of thumb in your head, aggregate emerging market and developing economy growth, potential growth, fell from 6% in the first decade to 5% in the second decade to 4% in the third decade of the 2000s. And in per capita terms, it slows from 5% in the last decade to 4.2%, 5% in the first decade to 4.2% in this last decade to 3.6% over the remainder of the 2000s. And that's the good case. And that's what the other two charts on the right, in the center and on the right, show you. That these baseline assumptions, I told you, these are just UN assumptions, consensus forecasts, and the same pace of policy reforms as in the past decade. There are no shocks to this. Yeah, we're not assuming any repeat of the shocks that we have seen in the past decade. No more recessions, no more banking crisis, no more epidemics. Because every one of these big economic disruptions leaves a legacy of a lasting legacy of lower potential growth. And that's what we show you in the chart in the center and on the right. Here we've run a series of local projections models of potential growth on these shocks, on recessions, national recessions, global recessions, on banking crises as defined by Love and Valencia, and on epidemics. There have been a bunch of epidemics. It hasn't just been the COVID pandemic. There's been Zika, there's been SARS, there have been MERS and Ebola. So a bunch of recessions where epidemics where we can get a sense of what the impact on potential growth is. So here these charts show you again backward looking. This is backward looking data, so they can show you the production function approach. That's what's shown here. But again, for these regressions, for these particular regressions, it really doesn't matter which measure of potential growth you take. Yeah, the only measure that does not seem to respond to anything are expectations, actually, particularly real expectations. They really don't respond much. But all the other measures, they respond. For years after, you will see statistically significantly lower potential growth and lower potential total factor productivity growth after these big events. So these are not taken into account in our baseline recession. It could be, potential growth could be much lower if there's yet another recession. This slowdown in potential growth that we expect is something that stretches across a lot of emerging market and developing country regions. And that's what we show you here in this chart. It shows you again the 6 World Bank regions. You see the decline very clearly in East Asia and Pacific, where there's both investment weakness and aging underway. ECA, aging, and not so much investment weakness. LAC, MENA, and Sub-Saharan Africa are slightly different. Remember, we are not assuming any more recessions and crises. What we're actually also assuming for these 3 regions in particular, because they've been hit by many of such shocks in the last decade. We're assuming that these shocks do not recur. And that's the reason why in these 3 regions, potential growth may actually just be flat, despite aging populations, despite weakening investment. Yeah. So in these 3 regions, Latin America, Caribbean, Middle East, North Africa, and Sub-Saharan Africa, they might just be lucky and potential growth will not move much. If there's no more crisis, not the same crisis repeated that happened all over the last decade. South Asia, the region that we call SAR, South Asian region, that one will be the one with the highest potential growth rate, and is essentially driven by India, and within India, it's essentially driven by really unusually strong investment prospects in consensus forecasts. So consensus forecasts are really expecting investment in India to be resilient, to be very resilient. And that is what's driving the strong potential growth over the remainder of this decade. So the bright spot in this global picture among emerging markets and developing economies may well be the South Asia region. Now, this is a fairly bleak picture, but what we say in our press release, it's not inevitable. And let me show you why. So this production function approach, yes, we can use it for forecasts, but because of the way I told you that the way it's designed, we can also use it for various policy experiments. Because remember, health and education, for example, go into both labor force participation rates and productivity growth. Investment goes into total factor productivity growth as well as just into the capital stock. So we can do various what-if scenarios. What if policies did a certain thing? And that's what this slide shows you here in the chart on the left. What if? What if? And here we deliberately took a scenario that's difficult but not impossible, because we took for every country its own best performance in investment growth, 10-year performance in investment growth, in improvements in education and health, and in improvements in female labor force participation and old age worker participation. So every country repeats its own best 10-year record all at the same time. So not impossible, just a little difficult. But that would be enough to reverse the slowdown in global potential growth. That's what the chart on the left shows you. Yeah, global potential growth is expected to fall from 2.6 to 2.4%, the two blue bars here on the left. But if every country implemented all at the same time this best 10-year performance, this would actually reverse the slowdown, raise global potential growth back to 2.9%, halfway back to the first decade of the 2000s. Now, what could generate this kind of policy effort? Well, there are two policies in particular that we looked at. One is climate-related investment, and one is female labor force participation-related reforms. So just to give you a sense of the potential of climate-related investments, you may know that the World Bank is doing all these country-specific country climate CCDR diagnostic reports. So it estimates for every one of its client countries, it estimates the amount of investment needed in % of GDP per year to meet the climate targets, the Paris climate targets and adaptation targets. So for low-income countries, that's huge, that's 8% of GDP. For middle-income countries, also fairly large, 5% of GDP. For upper middle-income countries, it's not so much. So as it happens, the average is 2.3% of GDP. That would be about half of that purple bar on the left. Yeah, these climate-related investment needs. So perhaps the climate-related investment is exactly what is needed to turn around, to give you that purple part, to give you that policy boost to turn around investment, potential growth prospects. The other scenario we looked at is specific to two regions that are particularly weak in that respect. Female labor force participation in the Middle East and North Africa is about it's about a third of that in the average EMDE. And in sub-Saharan Africa is about a third less than the average in EMDEs. So here now, what would happen, not if MENA and SAR repeated their own best effort, that wouldn't generate much, but what would happen if MENA and SAR raise their female labor force participation all the way up to the EMDE average? If these countries, all countries did that starting today, starting in 2022 and phase it in over the next decade, that might just lift their potential growth by more than a percentage point if you apply our scenario. Now, these scenarios, they assume no structural break. They basically take past trends and the forecast that everyone has, and that gives you the baseline projection. But maybe there are some structural breaks. So we look at two things in particular, one bad and one good. The one area where there seem to be particular challenges at the moment, but which has been a big driver historically in emerging market and developing economy growth, is trade. And there very clearly, the trade is drying up as a source of investment, for a source of growth for emerging markets and developing economies. So you may have heard that the elasticity of trade to growth has halved essentially. So in the period from 1990 to 2011, trade growth was about twice what GDP growth was. Elasticity was about 2 roughly. Over the last decade, it was essentially once. So trade was just about keeping pace with GDP growth. This has nothing to do with the pandemic. That started long before the pandemic. This has good reasons. One reason is that investment growth was so weak. Ayhan showed you that slide. And another reason that is becoming increasingly apparent is that these global value chains are not really retrenching. We don't see that in the data yet because the data lags, but they're maturing. So they're no longer growing. So they're no longer creating this virtual spiral of faster growth and faster trade growth. So they're maturing. So at this point, trade is just about keeping pace with GDP growth. So if a country wants to generate externally driven growth, it cannot rely on the world pulling its growth up. It has to increase its market share in the global economy. And to do that, many countries need to reduce trade costs because trade costs on average are very high. On average, trade costs are double. They double the cost of an internationally traded good over a domestically traded good. So we've run a series of gravity model type regressions for trade costs, not trade flows, bilateral trade costs, to see what is driving trade costs. And there's 3 major culprits. Tariffs is actually the smallest part of it. Remember that the trade costs themselves double the price of international goods compared to domestic goods. Tariffs are somewhere on the order of 4% of the value added. So it's a different order of magnitude. Trade costs are much more than tariffs. What are they? They are logistics problems, they're shipping problems, shipping costs, and they're border documentation. Those account for a sizable part of global trade costs. So in these we can use these gravity models to estimate what would be the impact of a country doing reforms in these 3 dimensions. And the particular reforms we estimate are a country that is in the bottom quartile by logistics performance, by shipping cost, and by border processes, border documentation, border processes, wait times, that kind of thing. What would happen if a country in the bottom quartile improved these things to the average of a country in the top quartile? So that's a very bold experiment. You have to bear in mind, this is essentially turning Sierra Leone into Poland. But that kind of reform would have huge benefits. It would essentially halve the trade costs. That's what you see here. The one line is the normal trade cost without reform. The comprehensive reform bar here is what trade costs would be like if that country in the bottom quartile improved its shipping, logistics, and border processes to the country in the top quartile. So there could be sizable gains from this, especially for a lot of emerging markets. I'm not sure it applies so much to New Zealand, but for a lot of emerging markets, this is a major issue. Now, Ayhan already touched on this. Another area where there has been a lot of hope that growth, it could be the new driver of growth, is services. And everyone talks about it or has been talking about it for a while. It's a new driver of growth, but actually it's been driving growth for a long time. In advanced economies, it's actually been driving all the growth, the average growth between 1995 and 2013. And in emerging markets, it counts for two-thirds of the growth. So it's long been, it's a large share, it's about 2/3 of the global economy. It's long been an important driver of growth. And it's a large share of the global economy. And there is a lot of hope that this digitization that was caused by the pandemic will trigger a structural change that breaks that chart that I showed you in the previous slide with the baseline forecast. So what we need is a structural break. We need to have a turnaround in all these trends that push down potential growth. Maybe this digitization will be the turnaround, and services, domestic activity and trade can be the thing that turns it around. There's one caveat that you don't see here in the slide, but that is in the book, in figure 7.3, the productivity of services. That figure shows you the labor productivity and the total factor productivity of about a dozen individual services industries compared to manufacturing. The highest, the biggest gap to manufacturing, the 2 industries that have much higher labor productivity and total factor productivity than manufacturing are finance and real estate. It's a risk. Those have to, growth driven by those two sectors has to be very carefully managed and needs to be accompanied by very careful macro policies. ICT actually in emerging markets also has somewhat bigger, higher labor and total factor productivity than manufacturing, but the gap is not that large, and these sectors are still small. So it will take a big policy push to really grow on ICT for emerging markets and developing economies. So to turn around that baseline forecast of potential growth slowing by yet another almost half percentage point, from 2.6 to 2.2% globally, it will need a big policy push. All the trends are currently against it. It will either need a policy push or it'll need a miracle. Maybe this digitization is the miracle, that it needs to turn potential growth around. Maybe there's some other, maybe I have ChatGPT, maybe some artificial intelligence, maybe the things that Eric Brynolf mentions, that Ayhan mentioned at the beginning. Maybe those will be the miracle that turn everything around, but it needs one or the other. Otherwise, global potential growth will slow. It's all the trends are to depress it. So just to summarize, how has potential growth evolved over the past decade? It's down. It's down by any measure in just about every country. Just about every region, just about every driver of potential growth is down. Looking ahead, unless there's a big structural change, things are going to continue to point down. Growth will slow further. So what it needs is really a structural break. It's either a complete turnaround in policies in many countries at the same time, or it needs a miracle. It needs a productivity miracle. Maybe some of these breakthroughs that Ayhan mentioned in the tech optimists were discussing even before the pandemic. And of course, all of this is developed in much greater detail in this particular bottom left study that we've just released, but we also released a study on productivity growth that also has some of the details. And we discussed some of the implications of the informality also for growth that we don't touch on in this particular presentation here. And with that, thank you very much. I look forward to the presentation. Sorry, to the discussion.
Thank you very much, Ayhan and Franziska. Really appreciate the talk. Fascinating to get such a comprehensive array of facts on what has actually happened to productivity in such a broad range of countries, and just to see how sort of widespread this slowdown in productivity has been, and really interesting sort of set of objective evidence on, I guess, comparing the lowest performers to the highest on certain aspects of economic reform that can change productivity. So we've had a number of questions, and just to remind everybody, if you load your questions, I'll be going through the Q&A, not the chat. So the Q&A at the top there is what I'll be looking at to sort of figure out questions, and I might just sort of aggregate some of them. I guess the first question is, there has a slowdown in investment was mentioned as a cause of productivity, and importantly was a major factor in your sort of prediction that productivity is going to slow further between 2022 and 2030. So have you got views on the cause of that slowdown in investment and why we're not expecting any change over the coming 10 years?
I can start with this. So investment is a tricky one because it has this circularity, no? It has this accelerator effect that if investors are not expecting growth, they're not going to invest. So it feeds on itself. You get these accelerator effects. So certainly it is clear that over the past decade, consensus forecasts have not only fallen for investment, they've also fallen for growth. So clearly investors are expecting slower growth, and that is a reflection of this. Now that then comes back to why do investors expect a slower growth? And it's probably a combination of things, but one of the things may simply be that the productivity gains have clearly slowed looking backwards. And it's not clear, there is no hard evidence yet that they're going to turn around over the future as well. So that is probably, it's all an accelerator mechanism between the various factors. I hand back to you.
I think we can move on to other questions. I'm happy to talk about investment, but I see there are so many questions there.
I forgot one more comment. It doesn't help that government investment will be heavily constrained, and of course, interest rates are going to stay high for a while. But the trend is much longer standing. It's not just about the last couple of years where monetary policy rates were high. It's been a long-standing issue with financing of investment. On the government side, it's been an issue. And on the private side, FDI flows have also been weak to emerging markets and developing economies. So financing will be an issue for a while.
Thank you. Another early question. Do you think productivity growth has been limited by natural planetary boundaries or limits to the natural capital available to economic growth?
Ayhan, do you want to?
Please go ahead, Franziska. Please, I'm writing it to you.
Hard to tell. So we don't have it. Of course, we don't have it in our analysis. It would be. I'm not. We don't have natural resources in our analysis. That's actually one of the extensions that we suggest for the book. It's an obvious extension, especially for commodity exporters, that you bring in natural wealth. And there's increasingly data that it should be possible to do this, but we haven't done this. It's an obvious extension of our work here. We should do this.
So, Dominique, this is actually an important question because it covers certain other issues we are working on. There is one challenge that I think you mentioned in your opening remarks, climate change. And climate change has a huge impact on productivity through a variety of channels, but especially through natural disasters. We see that impact in the context of, for example, small states. We released a major study on small states in January. And you have neighbors, small state neighbors, and of course in the Pacific as well. Now, one of the big things we need in the context of climate change and coping with the effects of climate change, these rare earth metals, to have a meaningful energy transition. And the availability of these metals will have consequences when we think about that transition. And of course, if we are able to do that transition in a smooth way, that will be fantastic. But given the competition, and we see that strategic competition already taking place, unfolding in front of our eyes, and becoming a kind of a major power competition, there are significant consequences whether natural resources are there. And then there is the other side of the coin, the possibility of resources we think out there, but they can, let me put it correctly, become stranded because of the pressures associated with climate change. And a number of countries, this will translate into a outright collapse in productivity because they will basically use a big chunk of their resources if those the climate-related pressures intensify. This is like, you know, the pandemic. You don't start the year thinking about, we might have a pandemic in one of these months. We never start the year thinking, this is the year we will really hit by climate change. But at this rate, we might have one of those maybe during the next 5 years, 10 years, 15 years. It has to be seen. And it will have huge consequences.
Thank you. I might actually just jump in with my own question, if that's okay by everybody. And that is, I understand the slowdown in potential growth due to certainly due to slowing population growth. But I find the slowdown in productivity, it is mysterious when you consider the incredible pace of development in the likes of the internet, smartphones, the way our lives have changed. Just as a human being with access to these technologies, it just strikes me as hard to understand how our lives have become less efficient, or the growth rate of the improvement in efficiency in our lives has deteriorated when I just experience these enormous improvements in efficiency of my life each day. So it does become hard to, it becomes a bit of a mystery, and I am aware of work suggesting that essentially the statistician has had trouble keeping up with technological change, and things like maps are no longer part of GDP. They're a free service operated through our smartphones. So do you think issues with measuring GDP might have contributed to the measured slowdown in productivity growth?
That's quite possible. We wanted to look at that. We haven't done it yet, and we just use investment data. But really, one should look at intangible investment. That has a bit the same issue. Supposedly huge, but very poorly measured, and it's not clear which way. There's a sense it's going up, but there are very few studies that actually show it is going up on a broad-based, in a broad-based manner, not just in the US. So it might well be that there are statistical issues that we can only capture what the official statistics in a lot of countries are telling us, of course.
Thank you. Okay, so a question about the public sector, which is another thing that actually I mentioned in my opening comments. So especially in emerging market development economies, it's hard to argue that public sector efficiency is close to the frontier. Do you think public sector reforms can have a role in increasing potential growth by increasing marginal efficiency in public investment?
So I think that the challenge in many emerging market and developing economies is to increase the efficiency of the public sector, given the important role the public sector plays. And we operate, in Latin America, we operate in Africa, South Asia, and we definitely see the kind of the need to improve the efficiency of public sector. And the efficiency of public sector manifests itself in different dimensions. Take, for example, revenue collection. In many countries, you look at, revenue to GDP ratios much, much lower. And these countries need to be able to raise revenues, reduce informality, translate the kind of the collected revenue into, long-term growth enhancing projects. And the challenge is that all of these things are easier said than done. What happened during the past decade, Dominic, when we look at, for example, the debt data, emerging market developing economies, whether you include China or exclude China, experienced the largest increase, fastest increase, and the most synchronized increase in debt. So they were accumulating debt they have never done before. But that debt has not translated into faster actual growth and has not translated into faster productivity growth. So government has been accumulating debt at a frantic pace, covering things, and then we already talked about investment slowdown. So there is a serious efficiency question we need to ask at the aggregate and try to find an answer. And then those are the types of issues we need to really, as economists, to be much more proactive to help the policymakers and guide them. Back to you.
Thank you, Ayhan. So a question on female labour force participation. Does the impact vary between countries depending on existing levels? So I presume that means, are there sort of low-hanging fruits, a lot of gain from increasing female labour force participation at the start and then a change as you go up the curve, or does the marginal impact vary between countries?
Yes and no. Yes, it does, in the sense that for every country, for this little scenario we did, we assume for every country that each female labor force participation group moves up to the male in every group over a 10-year period, slowly. Yeah, so yes, since countries have different female and male labor force participation rates, they move up different. Sorry, no, sorry. No, the 10-year best in performance is just an aggregate. So yes, it's country specific. Every country repeats its 10-year best, and that's improvement. Then the MENA and SAR, there we raise the female labor force participation for every 5-year age group by to the EMDE average, not to the males, to the EMDE average for women. So again, it's a bit country specific because there are different gaps to the EMDE average. So there are some countries that have huge. So the outcome, the impact on growth in these two scenarios really differs on either whether they've done much over the last 2 decades. So there is a point in having a repeat to the best 10-year performance, or in the second scenario, how far away they are from the EMD average. It does depend on the country.
Thank you. So we've got a question about productivity or knowledge dispersion among firms. So at the Brookings workshop recently, Chiara Crisciolo noted that there is increased productivity dispersion in firms, i.e. large firms at the technological frontier benefit and other firms less so. Knowledge is in principle non-rival, but it can also be a source of competitive advantage. What role do you see for policy in managing this tension, knowledge dispersion?
So there are different ways of thinking about the knowledge dispersion and gains in productivity, and the role of public policy, Dominic. Increasingly, when we look at the interventions, we realize these micro interventions are critical. You are not making big macro interventions, but micro interventions in terms of having stronger R&D groups, having stronger partnership between universities and the private sector. And then as much as you are, undertaking those interventions, at the same time, you let the Schumpeterian forces to be in play. There is as much as knowledge dispersion with the new innovations. Some firms have to disappear, and you let that happen. So on the one hand, you intervene and try to promote new innovations. On the other hand, you also let the firms that are unable to compete die, and there is this, of course, the greater dispersion of knowledge. You see all types of countries, advanced economies, emerging market, developing countries. You go to Africa, they have all types of ideas. Every country has a center of incubator to foster productivity, innovation, and then the dispersion of knowledge. And I think these things, when I look at certain countries, have incredible returns. Do they translate into, the more jobs? Do they translate into faster growth? Do they translate into better living standards? We need to see, I think, the benefits over the coming years.
Thank you. I think we'll go to a question about the way you've stripped out business cycles and shocks in your modelling. So have you considered the possibility that the shocks could be endogenous to some of the policies that have been used to pursue economic growth. The frequency of shocks being endogenous to the policies pursued.
That's a good question. Very good question for future research. We have not done it. But yeah, I mean, we take the shock, the recession, but also there's a reason why because our sample, I mean, our main emphasis, our mandate is for emerging markets and developing economies. A lot of the shocks come from outside, and then they're amplified by the domestic policies. But a lot of the things that actually trigger terrible things often come from outside. It's actually one of the most frequent causes of financial crisis. In that book, in that debt work we did, we looked at 41 financial crises and what triggers them. The most frequent cause of financial crisis was a combination of some external shock, usually US monetary policy rate increases, combined with some domestic vulnerabilities built up. But it's something one should do. We have not done it. Yeah.
Thank you. So we've got a question about investment opportunities. So if it's the case that there's a surplus of capital and a shortage of productive investment opportunities, so I'm not, you may or may not agree with that proposition, but if that's the case, is it realistic to expect to replicate the exceptional investment performance of the past decade? Or will investors need to adjust their strategies to account for this new economic environment? And if so, in what ways?
The answer is no. So, look, I think the big challenge is that we had this idea of secular stagnation for an extended period of time, and that when we were discussing these issues, interest rates were low. In fact, when you go back and look at the data, we looked at these issues very carefully in the context of our work on stagflation. We never had a period like the one we had over the past decade in terms of how low real interest rates were. Despite that, we did not see a surge in investment, especially, of course, in emerging market developing economies. In fact, we saw investment momentum really sapped. So going forward, the big question is that what is the big role for public policy to use the resources and bring private sector to accelerate investment growth? Because all of these things we discuss at the end is about investment. To have productivity growth, we need to invest. We can say, oh, let's have more female labor force participation. That's a wonderful thing, but we need to invest in education of that female labor force. We need to find, ways to, cope with. I talked about climate change, and at the heart of all of these issues, there is the desire to invest, and we need to think about why there is this so little investment in an environment. We need much more to enhance long-term growth prospects. And Dominic, there is one question. I was looking at the Q&As, and I really like that question. I will talk a little bit about that. The quality of governance, what happened to quality of policies around the world over time. I think it's difficult to say whether fiscal policies have gotten worse or monetary policies have gotten worse. But the quality of governance has deteriorated. And you see that in the reaction of societies, the desire to find new political actors, the desire to resort to populist interventions, shortcuts, and the consequences of that, of course, erosion of institutions and erosion of the quality of governance. And that translates into exactly the type of policies we economists, disagree with. And unfortunately, we have seen that in advanced economies, we have seen that in emerging developing economies. In some cases, of course, these ended up seeing these policies in countries we would like to see much faster growth, because they are the countries, highest or higher poverty rates. In the World Bank, we monitor these things different ways. And you look at, where do we need growth? Faster growth. Of course, we need faster growth in countries with highest rate of poverty. Where do we see slowest growth? In countries with highest rate of poverty. And there are huge consequences when we think about social tensions. In an environment, you have high inflation, weak growth, and weaker long-term growth prospects. There is that challenge in front of policymakers, which require, better governance, better quality policymaking.
Thanks, Ayhan. I think that's a reminder that economic first bests are, economics is subservient to politics and operates within a political environment. Those are excellent words, I think, to remind us of and to finish on today. So we have run out of time. Thank you very much, Ayhan and Franziska, for a fascinating presentation and a really interesting Q&A session. And thank you, everybody who's attended today. Thanks also for your questions. Our next seminar in the series will take place on 31st of May. We'll have Chad Severson, the J. Baum Harris Professor of Economics at the University of Chicago. Chad's research spans several topics with a particular focus on the interactions of firm structure, market structure, and productivity, which was something actually I think that came up today. So I look forward to virtually seeing everybody at that presentation. In the meantime, I will close today's seminar with a whakatauki for Ayhan and Franziska. That's a Māori proverb. This whakatauki talks about discussion, learning, understanding, and knowledge underpinning the well-being of people. Mā te kōrero, ka mōhio. Mā te mōhio, ka marama. Mā te marama, ka mātou. Mā te mātou, ka ora te iwi. Haumi e, hui e, tai ki e. Thanks once again, Ayhan and Franziska, and thanks everybody. Mā te wā.
Thank you, Dominic. Thanks everyone for joining us and raising questions.